Ever noticed how billionaires like Rockefeller never seem to own much in their own name? No flashy mansions tied to their personal credit, no supercars on their credit file, few big assets screaming, "This belongs to me." Yet they are swimming in wealth. John D. Rockefeller, the man who built one of the greatest fortunes in history, whispered on his deathbed, "The secret to success is to own nothing but control everything." That is not a coincidence, that is a strategy. The rich don't own assets, they control them through layers no one sees. They have cracked the code. Personal ownership is equal to taxes, vulnerability, while control without ownership is equal to freedom, protection. And in the UK, it is happening right under your nose, like limited companies, holding structures, trusts, and clever setups that quietly shield property, investments, and cash flow. Hi, I'm Rubina, a qualified accountant, and in this video, I'm breaking it all down for UK business owners, directors, and landlords like you. You are about to discover why the rich obsess over control, not ownership. How UK limited companies and smart structures protect wealth from HMRC, creditors, and life's curveballs, and the mindset shift that can transform how you build, save, and protect your money for life. Stick around because once you stop thinking like an employee and start thinking like the wealthy, everything changes. Hit that like button if you are ready to level up. Subscribe for more UK wealth protection tips, and let's dive in. The big misunderstanding about wealth. Most people misunderstand what the rich are actually doing. The rich are not primarily trying to hide what they own, they are trying to protect it. When you own something personally, your home, your car, savings, it is legally tied to you. Perfectly fine. But if you are ever sued, made bankrupt, caught in a messy divorce, or in a serious tax dispute with HMRC, those personally owned assets form part of your estate. That means HMRC creditors and lawyers don't need an invitation. They can walk straight through the front door of your balance sheet. But if a company owns those assets and you control the company rather than owning them directly, the rules change completely. You don't personally own the assets anymore. You own the entity that owns the assets. It sounds complicated, but it is not. Under UK law, a limited company is its own legal person. It has its own assets, its own liabilities, its own problems, separate from yours. That separation is where the protection lives. This is the kind of structural difference that the wealthy pay a lot of attention to, and most normal people never think about it. The thing that holds most people back is, "This sounds complicated." That is probably not for people like me. I'm just a small business owner, freelancer, not a millionaire. The wealthy hear that voice too. They just recognize it as a noise. They notice it, thank it for trying to keep them safe, and act anyway. Confidence with this kind of thing doesn't come first. It comes from taking action, asking questions, and setting things up properly. When you start analyzing this, you will see it everywhere. Properties held in company names, not individuals. investments sitting inside holding companies, intellectual property, brands, courses, content owned by businesses, not people, property portfolios split into different SPVs, special purpose vehicles to ring fence risk. They have built a financial firewall between themselves and their money. And that firewall is not made of fancy offshore tricks. It is made of structure, paperwork, and planning ahead instead of panicking later. Once you understand that principle, the next logical question is okay, but how do they actually build that wall? Because it is not magic, it is just using company law and tax rules in a legal and logical way. The mindset gap. What we are taught versus what the rich learn. Most of us are raised on the idea that owning things personally equals safety. Pay off your mortgage, buy your car outright, put everything in your own name. We are also fed a lot of unchallenged money truths. Money does not grow on trees. Investing is risky. You should be grateful for one stable job. But no one asks the obvious follow up. Risky compared to what? Because relying on one salary is also risky. We just pretend it. Watch my video on the salary trap here. The wealthy learn something different, either from family or because they force themselves to question everything. One of the biggest lessons: exposure is the real risk. So they prioritize control, flexibility, downside protection. Their question is never how much can I make? It is if something goes wrong, how much can this actually hurt me? That is the game they are playing. Owning very little, controlling a lot. Let me share an example of one of my clients to identify its business structure. A director personally owns the shares in a holding company. That holding company owns a trading company, a property company, a company that holds intellectual property or online courses. The director controls everything via share ownership and directorships, but personally owns very little in their own name. Another client owns property through SPVs. Landlords use SPVs and limited companies to hold properties, sometimes one SPV per property, especially for HMOs. Why? If one property goes wrong, legal issue, tenant dispute, major claim, the others are protected. If they want to sell, sometimes it is easier to sell the shares in the SPV than the property itself. Again, structure, not magic. When does this start to matter? This is not only for people with seven-figure portfolios. These questions usually become very relevant when profit hits around 50,000 to 100,000 pounds, cash starts building up in the business, you are thinking about growth, property, or a future exit. You don't need to be clever. You need to be strategic because once the money lands in your personal name, you made a decision. So far, limited liability and separation sound amazing, but there is a catch. If you blur the lines between you and your company, you can quietly undo a lot of that protection. Red flags that HMRC, lenders, and courts look for: using the same bank account for personal and business spending, running loads of personal costs through the company that are not genuinely business related. No proper contracts, no invoices, no paper trail. Treating the company like a wallet with a logo, not a separate legal person. So, Run your company like a business. Separate accounts, proper records, clear contracts. Personal guarantees, the silent killer of limited liability. Be very careful with it. Banks and lenders love a personal guarantee. It is their comfort blanket. The moment you sign one, that debt stops being purely the company's. Your personal assets can be on the line, including your home. Wealthy individuals often use the company's track record and assets to negotiate. Use a holding company or wider group balance sheet as strength. Negotiate caps, limits, or insurance when a guarantee is unavoidable. Before you sign any lease, loan, or finance agreement, ask, is this in my name or the company's name? That one question can be the difference between losing a business or losing a business plus your house. Ensure the structure, not just the business. Ensure not just what you do, but how it is set up. The wealthy don't just think, is my office insured? They also think, is my role and my structure protected? That means considering things like directors and officers insurance protects you personally against claims of mismanagement or breach of duty. Professional indemnity insurance, essential if you give advice or provide professional services. Legal expenses, insurance, because legal costs can cripple cash flow. Don't put everything in one basket. It is usually bad practice to have trading, property, intellectual property, investments all in a single company. If that one company gets hit by a big claim, a major tax dispute, or it has to be wind up, everything is at risk together. This is why wealthier individuals often separate trading companies, property companies, IP or brand companies, holding companies. That way, if one part of the group has a problem, the others are insulated. So, if companies own everything, how do the rich use it? Three big reasons. Number one, risk and liability. Number two, tax timing and flexibility. Number three, cash flow and leverage. Let's unpack these in UK terms. Number one, risk and liability. If it's in your personal name, it is exposed to lawsuits, business failure, divorce, professional negligence claims, aggressive HMRC investigations. If it is in a company's name, there is a layer between you and the assets. It is not bulletproof, nothing is. But as accountants like to say, if it's not in your name, it is harder to take. Not impossible, just harder. That extra friction buys you time, options, and negotiating power. Number two, tax timing, not tax dodging. This is the bit that is often misunderstood. It's less about avoiding tax and more about controlling when it becomes personal. If you earn £1,000 personally as income, income tax kicks in, national insurance often joins the party, HMRC gets paid first. You don't get much say in the timing. If a company earns that same £1,000, corporation tax applies, yes, but after that, you decide when and how that money becomes yours personally. That could be through dividends, pension contributions, long-term capital planning, or simply leaving profits in the company to reinvest. Same £1,000, same UK tax system, totally different timing. And timing matters because it lets you smooth your income across years. Avoid pushing yourself unnecessarily into higher tax bands. Reinvest pre-personal tax profits into assets or other businesses. When people say companies save tax, they are only half right. what companies really give you is flexibility. In tax, timing is half the game. Number 3, cash flow and leverage. The quiet superpower when money stays inside a company. 3 powerful things happen. Number 1, it can be reinvested before personal tax, so you are growing with a bigger pot. Number 2, company held assets can be borrowed against. Banks like balance sheets and predictable cash flow. Number 3, growth compounds faster because less money leaks out via personal tax each year. This is why wealthy people don't just ask, what do I own? They ask, how does money move through my system? Wealth is not just a pile of stuff, it is a machine. Cash comes in, gets recycled, and grows before it ever becomes personal. They usually get money through a mix of 3 routes. Number 1, salary. Number 2, dividends. Number 3, directors' loans. Used carefully. Do the rich really own nothing personally? They still own some things personally. Typically, ISAs, pensions, some personal cash and investments, their home, sometimes, and lifestyle assets they actually want to enjoy. They are not avoiding personal ownership altogether. They are avoiding owning the wrong things in their own name. Highly exposed assets, high risk activities, large business related assets that could attract claims. So the real difference is the rich don't avoid ownership. They are selective about what they own personally. You don't need to be rich to use these rules. This is not some secret reserve for billionaires. Every UK limited company director, freelancer, consultant, landlord already has access to the same company's rules and start treating structure as seriously as sales.